Hey everyone, Zack Benjamin here. I hope you all have had a nice week so far. I wanted to talk this morning about investing for the long haul and give some realistic expectations for market volatility. Because I think as humans, we're naturally adverse to risk, and there's not a great feeling when we see our portfolios go down. But let's take a look back in history. And for this, I just simply want to look at the S&P 500. And yes, I'm a couple years off on these numbers, but the data I was looking at goes from 1953 to 2022. So we're covering a 70-year time period here. So over the course of those 70 years, you actually had intra-year declines on average of 13.9%. So meaning even when you had up years, you still saw a lot of volatility in your portfolio. Now I said, hey, we had an average intra-year decline of 13.9%, but you made money in 50 of those 70 years. But again, I think it's important to have realistic expectations of how the market performs. There's so many people on TV, so many articles you read that say you should average 7, 8, 9, 10%, whatever the figures are that they're pulling from. But in reality, when we look at how markets perform, you should expect to see a decline of 5% or more. These happen on average every 10 months. Now, declines of 10% or more, these happen on average every 2.5 years. Declines of 20% or more, so the ones that are a big hit, these happen on average every 5.8 years. And one of the last major ones we had that everyone still thinks about was 2007, 2008. But since then, we've had a number of poor years. 2022 was a poor year. 2018, we all remember what COVID did in 2020, where you had massive swings in a short period of time. So I just wanted to drop in and remind everyone that it's all about investing for the long haul, not what happens over a 3, 6 month, 1 year, or even a 3-year time period. Know what you bought and why you bought it. And to make sure your plan is appropriate, please get in touch with us and we'll be happy to review that again. Have a great weekend.